Before you send that extra mortgage payment this month, just wait a second. I'm not saying paying off your mortgage is dumb. I'm saying doing it automatically without thinking might be. Look, most people don't sit down and calmly decide to overpay. They react. They see rates go up. They hear someone shout, "Debt is dangerous." They feel uneasy and they throw money at the mortgage because it feels like taking control. But reacting isn't the same thing as having a plan. Here's something I've noticed. Being mortgage-free feels powerful, not logically, emotionally. There's no letter through the door, no lender's name attached to your home, no monthly reminder that you owe someone. It feels clean, it feels like independence. But independence and resilience aren't the same thing. You can own your house outright and still be one bad year away from stress. Picture it, you're standing in your kitchen, no mortgage. The house is fully yours. You smile. Then your income stops. The house is still yours, sure, but the council tax still shows up. Energy bills don't disappear. Insurance renews. Food still needs buying. Maintenance doesn't care who owns the place. So what exactly changed? You removed one expense, you didn't remove risk, and we mix those up all the time. Now flip it. You still have a mortgage, but you've got a year's worth of expenses sitting in cash. You've got some investments quietly ticking along. You've got options. You might still owe the bank, but you're not tense. Because if something goes wrong, you've got breathing room, and breathing room is everything. This is the bit people don't talk about. Your biggest financial risk isn't the mortgage, it's losing income, it's instability. It's being forced to make decisions when you're under pressure. And when people aggressively overpay, they often shrink the very thing that protects them from that. Liquidity money. You can actually touch money that moves fast. Money that buys you time. Time is underrated. Time lets you think. Time lets you avoid panic. And panic destroys wealth faster than interest ever will. Let's talk about the UK for a second. Our mortgages aren't fixed forever. You fix for a bit, then it resets. You negotiate again. It's a cycle, and cycles matter. If you overpay heavily in one phase, you might weaken yourself for the next. Imagine your fixed rate ends soon. You've been smashing overpayments. You feel ahead. Then the new rate isn't what you hoped. Your payment jumps. Now that pile of money you locked into the house would have been very handy in cash. That's not theory, that's timing. And timing is ruthless. Now investing instead. The other camp, they say, keep the mortgage, invest the difference, and in theory that can work over long stretches, markets grow, inflation eats away at debt, blah blah blah. But here's the part they whisper. You have to actually invest, consistently, without flinching, without touching it, without panicking when it drops. Be honest, could you? If markets fell and headlines screamed and everyone at work was talking about losses, would you calmly continue? Or would it get under your skin? This isn't about intelligence, it's about temperament. I've seen smart people make terrible decisions because they couldn't sit still. Investing requires emotional stamina. Overpaying requires discipline too, but it feels safer. It's visible. You see the balance fall. It feels productive. Investing is quieter. Sometimes it looks like nothing's happening. Sometimes it looks like it's going backwards. That messes with your head. And here's another uncomfortable bit. A lot of people say they'll invest the difference. Very few actually do. They mean to, they start strong. Then something comes up, a holiday, a car repair, a random expense that felt urgent in the moment, and suddenly the investment plan turns into lifestyle creep. It's not malicious, it's just human. Now here's something hardly anyone mentions, the middle ground. Keeping cash against your mortgage without killing it, reducing interest quietly, but keeping access. It's not dramatic, it won't impress your mates, but it respects uncertainty. And uncertainty is real. Life rarely unfolds neatly. Problems stack. They don't queue politely. A job wobble doesn't wait for markets to recover. A health scare doesn't check your portfolio first. Life compresses stress. And when stress hits, liquidity is oxygen. No oxygen. Bad decisions happen. Now let me ask you something slightly uncomfortable. Why do you really want to pay off your mortgage early? Is it optimization or is it fear? Fear of banks. Fear of debt. Fear of vulnerability. Fear isn't bad. But unchecked fear can push you into rigidity. Rigidity feels safe until the world changes. And the world changes constantly. You can't predict rates perfectly. You can't predict your career perfectly. You definitely can't predict markets perfectly. So building a strategy that assumes smooth sailing is risky. Better to build one that survives rough water. And here's something else people forget. Overpaying isn't reversible in the way you think. Yes, technically you can refinance or release equity, but that's slow. That's conditional. That depends on lenders saying yes. Emergencies don't wait for lender approval. You don't want to be filling out forms when you're stressed. Stress narrows thinking, and narrow thinking leads to short-term fixes. Short-term fixes create long-term consequences. Let's talk about something people rarely admit out loud. Sometimes overpaying feels morally superior, like you're doing the grown-up thing, like you're being disciplined while others are reckless. That feeling can be addictive, but moral satisfaction is not the same as financial strength. Strength is quiet. Strength doesn't need applause. Strength just survives. Here's another angle. When all your wealth is tied up in your home, you're exposed to one asset, one location, one market, one outcome. If that area stagnates for years, you feel stuck. If something changes locally, you feel it. Diversification isn't just a buzzword. It's about not being dependent on one story. Your house is one story. It's important, yes, but it shouldn't be your only pillar. I once saw someone pay off their mortgage early. Proudly, they felt unstoppable. 2 years later, their industry shifted, income dropped. They had a paid-off house and no flexibility. They didn't regret paying it off, but they admitted something quietly. They felt cornered. That's the word, cornered. You don't want to feel cornered by your own decisions. Now flip it again. I've also seen people obsess over investing while ignoring their cash flow risk. They chased returns, they felt clever. Then a downturn hit, and they panicked out at the worst time. That's the other extreme. Both sides think they're rational. Both sides can be wrong. The smartest approach isn't loud. It doesn't shout on social media. It looks boring. It looks like someone building cash reserves, reducing debt steadily, or investing consistently, not overreacting, not overcommitting, just layering strength. Layer 1, breathing room. Layer 2, income stability. Layer 3, asset growth. Layer 4, debt reduction. In that order, mess with that order and things wobble. Now here's a thought experiment. Imagine 2 people, 5 years from now, one raced to be mortgage-free. The other built flexibility first. 5 years in, an unexpected opportunity appears. A new role abroad, a business partnership, a market dip that creates opportunity. The first person hesitates because their capital is tied up. The second person can move. Which one feels freer? Freedom isn't the absence of debt. It's the absence of constraint. Constraint shows up when you don't have options. Options come from liquidity. Liquidity comes from patience. Patience comes from thinking long-term, and long-term thinking often looks unexciting. That's okay. Exciting is overrated. Stable is powerful. Let's talk ego again. Ego wants the headline, "I'm mortgage-free." Ego loves that sentence, but finances don't care about headlines. They care about structure. And structure either supports you or collapses under pressure. So before you act, ask yourself this. If something went wrong in 6 months, would I wish I still had this money accessible? That question alone filters a lot of impulsive decisions. If the honest answer is yes, you know what to do. If the honest answer is no, then move forward calmly, not reactively, not dramatically. Calmly. Because here's the real takeaway. This decision isn't about being clever. It's not about squeezing every drop of efficiency. It's about designing a life that doesn't fall apart when reality intrudes, and reality will intrude, unexpectedly, inconveniently, without asking. The goal isn't perfection, it's durability. Durable systems survive bad timing. Durable systems absorb shocks. Durable systems don't require heroics. They just keep going, and that's what you want. Not applause, not a trophy, not a dramatic milestone, just quiet strength. So don't rush to pay off your mortgage. Don't rush to ignore it either. Think, build layers, protect future you from panic. Because financial strength isn't about elimination. It's about endurance, and endurance quietly outlasts pride.